In today's video, we are going to uncover the hidden trading approach of open interest and change in open interest. Retail traders usually depend on option buying because of their small capital. When an option buyer takes a position, their attention stays on technical analysis using chart patterns, price action, or trading indicators. But large institutions, backed by big capital, prioritize market data over technical analysis for option buying or selling. That's the reason they stay ahead of everyone. So, if you want to operate in alignment with these institutions or operators, you must practice database trading like they do. It's rare that they'll openly reveal the direction their interest is shifting in the market, or where they re-entering or exiting positions. Hence, to gauge their interest, we need the ability to interpret open interest data, which is actually very simple. In today's video, we will talk about open interest and change in open interest, and how you can merge this with price action to identify market direction. We're going to break this down. Let's dive in, but before we proceed, if you feel this content is valuable, hit that like button. And if you're new here, don't forget to subscribe and enable notifications so you won't miss our latest uploads. I'll meet you right after the intro and disclaimer. So let's first understand what open interest is. As the name suggests, open interest refers to how much open interest traders have in the market right now, meaning how many positions are currently open at a particular strike price in the market, or how interested traders are in creating those positions. We can determine this by looking at the open interest graph for that strike price. An open position means that if a seller sells an option contract at a particular strike price and the buyer buys that option contract at the same time, then open interest is generated in the market. Until these two fully square off the positions, this contract will remain open in the market. Therefore, we call it an open position or open interest. If a large number of traders express interest at a particular strike price and buy and sell that option contract, the open interest for that strike price increases. This is what we call an increase in open interest. In the opposite market, if there are already some positions open at a particular strike price and which are adjusted, the open interest in the price begins to decrease, which we call a decrease in open interest. In simple terms, a buyer and a seller together execute a trade in the market. For example, if John buys a contract and David sells it, then open interest is generated. If John squares off his position and exits the market, but at the same time, Michael enters the market and buys that contract, then there will be no change in open interest in the market. Because one trader has left his position, another trader has re-established that position. Therefore, there is no change in open interest. This means that by now you have fully understood what open interest means. Increase in open interest, decrease in open interest, and no change in open interest. Let us now understand our open interest trading strategy. Now, since SEBI has decided to discontinue the weekly expiry of Bank Nifty, we will take the example of Nifty 50. This is a 5-minute time frame chart of Nifty 50. As soon as the market opened, the price moved up from the bottom, then crossed the psychological level of 25,000 and traded above this level for a while. If you observe, the price has also broken its previous high with a strong green bullish candle. According to the price action, a bullish candlestick pattern has appeared on the chart, which is considered a bullish indication. Furthermore, if you check the moving average, using indicators, the market has closed above the 20-period moving average, which is a bullish setup. Therefore, traders who rely only on price action and indicators they must have taken a long trade after spotting these trade confirmations. If you also entered a long trade here, do let us know in the comments. However, shortly after, the price turned from here and dropped quickly, causing losses. Now, many people would argue that after the market ends, anyone can claim that the price would fall from here. But, you can identify this market reversal even before it shows on the chart using an open interest strategy. If you examine the Nifty open interest graph at 9:15 a.m., the highest open interest in both call and put options is around the 25,000 strike price. But the call option currently holds an open interest of nearly 3.9 million rupees and the put option holds an open interest of nearly 4.6 million rupees. This indicates that the put option has an open interest of nearly 700,000 rupees more than the call option, meaning put sellers are dominant here, who do not want the market to fall below the 25,000 level. This is because of increased put writing pressure in the market. As bullish sentiment rises, the price gradually climbs here. All you need to remember about put and call writing is that whenever there is higher put selling or writing in the market, then this boosts positive sentiment in the market, pushing prices higher. Whenever call writers or sellers are greater in the market, the price declines due to stronger bearish sentiment. Now, as more put writers were present, the price tries to move above the 25,000 level due to stronger positive sentiment in the market. However, near 10:10, when the market breaks out and forms a long wick doji candle on the chart, if you check the change in open interest data, 89,000 new contracts have been added to the put side's open interest, taking the total open interest on the put side to over 6.5 million. Likewise, the call side's open interest data has risen by 2,197,000, bringing the total to 136,000. But if you notice the total open interest number, the put side's count is higher. However, we scalp intraday, so according to our strategy, we don't have to consider the total open interest data here. We only have to focus on the change in open interest data, i.e. how much change has occurred in the call and put open interest up to this time today. So, if we observe here closely, then from 9:15 to 10 to 1 minutes, open interest on the call side increased by more than 31,000 points compared to the put side. This suggests that put writers are currently losing interest near this level. Meanwhile, call writers are more inclined to push the market lower at this level. This level could behave as resistance, based on the change in open interest data. Therefore, we cannot even think of taking a long trade here. Hence, as soon as the price encounters resistance from above and then closes below the 25,000 level, we can avoid getting trapped in such fake breakouts by entering a short trade, keeping in mind the bearish price action and open interest data. Here are some parameters for applying the change in open interest strategy correctly. Or there are rules for which you need to closely analyze this table. If the market price keeps rising but open interest is falling, this indicates the bullish trend won't last long because fresh open interest isn't being created. As a result, the market could drop at any moment. Prices are moving up due to short covering, meaning traders who had already taken short positions are squaring off the trades. In the same way, if the price continues declining and open interest is increasing, it means market sentiment is turning bearish. Traders are showing more interest in selling at lower levels by creating short positions, which we call a short build-up. This adds selling pressure, marking the beginning of a fresh bearish trend in the market. However, if the market price keeps climbing and open interest is also rising, it indicates bullish sentiment is still strong, and most traders are willing to push prices higher, are ready to buy at the levels due to which new long positions are being built in the market, and long here a build-up of a bullish trend is forming, pointing to bullish sentiment in the market. Therefore, you can think about entering a long position here. Additionally, if the market price keeps declining and open interest is also dropping, it means traders should try to find their equilibrium. Let's also understand when to avoid using open interest. Point number 1. If negative news appears during or before trading due to war or diseases like the coronavirus, the support level shown in open interest on that day can fail, and this creates panic in the market, which is why the price keeps falling steadily. Point number 2. If a stock's annual results are positive, and a resistance level already exists on the chart based on open interest data, there is a greater likelihood of it breaking. So, you should avoid entering a short position here. Point number 3. If the price keeps moving toward a support or resistance level and tries to break it repeatedly, these levels are more likely to collapse due to being weaker compared to the prior levels. Therefore, regardless of how much open interest data exists around these levels, you should be careful when entering a trade here. Point number 4. Instead of depending on the previous day's open interest around a strike price, observe the live market. Your trade entry should be based on the change in open interest data. Plan your trading strategy so you can identify quality trades on the charts in the short term. That's it, traders. Thanks for watching this video. At the end of the day, your growth is your responsibility. No one else can put in the work for you. If today's video gave you the tools to improve, show some support by liking it. And if you're just joining us, make sure you subscribe and turn on the notification bell, so you're locked in for what's ahead. Keep learning, keep grinding, and remember, your breakthrough could be one decision away. I'll see you in the next video.